Allegion just completely crushed consensus for Q2 2026. Adjusted EPS came in at $2.40, which is up 17.6%. Revenues hit $1.15 billion, up 12.7%. And management actually raised their full-year guidance across the board. So the stock is obviously catching a nice bid this morning.
Yeah, I mean, posting double-digit top-line expansion and, high teens bottom-line growth in this specific macro environment is a massive signal.
It really is. And if you are holding Allegion stock right now or just analyzing the industrial sector, the mission of this deep dive is to act as your personal financial analysts.
Right, we're pulling this whole thing apart.
Exactly. We are unpacking their Q2 earnings call presentation and the financial reports to understand, exactly how they achieved this beat, where the growth is actually coming from, and of course, what the risks are that might be hiding in the details.
Yeah, because the headline revenue figure of that $1.15 billion, it looks robust on a reported basis. But when you analyze the geographic breakdown, it reveals two completely distinct operational realities.
Yeah, let's get into that because total organic revenue was up 6.9%. But the Americas segment is just clearly carrying all the weight here. I mean, they posted $918.6 million in revenue for the quarter.
Which is huge.
It is. That's an 11.8% reported jump, but more importantly, it's an 8.9% organic expansion. And they saw high single-digit organic growth in both the non-residential and residential businesses simultaneously.
Yeah, and seeing residential and non-residential move in tandem at that rate is, well, it's actually pretty uncommon.
Right, because they're totally different cycles.
Exactly. Usually those end markets operate on very different timelines. Residential demand is highly sensitive to immediate consumer sentiment, housing turnover, that sort of thing.
And mortgage rates.
Right. Whereas commercial or non-residential construction, that involves multi-year capital deployment. It's institutional planning. So for Allegion to capture high single-digit organic growth in both, it indicates they are really successfully pushing higher value product across their entire domestic portfolio.
Right. They aren't just relying on one lucky sector. But then you look at the international segment by contrast, and it's a totally different story.
Yeah, it's rough.
They brought in $232.9 million. And the reported number shows a 16.2% growth. But if you strip away the recent acquisitions, it reveals a 1.2% organic decline.
Yeah, that organic number is the truth teller.
Exactly. Because organic growth is the purest metric of actual demand, right?
Yeah.
It strips away the sugar high of just buying into the company. So why is the international segment shrinking organically while the Americas segment is just absolutely thriving?
Well, CEO John H. Stone actually pointed directly to this on the call. He called out softer demand across European end markets specifically.
Okay, so a macro issue.
Right. Europe is just experiencing a much heavier macroeconomic drag right now. And that causes construction starts to slow down and institutional upgrade cycles just get deferred.
Makes sense.
So that 16.2% reported growth was heavily propped up by, I think it was a 14.3% tailwind purely from acquisitions.
Wow, okay. So it just completely inflates the reported segment revenue.
Yeah, I mean, they are transparent about the organic decline in the fine print, but it still props up the headline. And because of that softening demand, Stone noted the international team is basically shifting into a defensive posture now.
Meaning what exactly?
Meaning they have to focus strictly on execution and cost discipline. When organic volume dries up, optimizing your internal cost structure is pretty much the only lever you have left to pull to protect profitability.
Right, you can't force people to buy locks, so you just have to make them cheaper, which actually brings a magnifying glass to their operating margins.
Oh, absolutely.
Because you can drive all the top-line revenue you want through M&A, but if it degrades your margin profile, you're just destroying shareholder value.
Exactly. Revenue is vanity, margin is sanity.
Love that. So total adjusted operating margin expanded 50 basis points to 24.2%. But the regional divergence here is even more extreme than on the revenue line.
It's wild to look at.
The Americas adjusted operating margin hit 30.1%, which is a 20 basis point increase. Meanwhile, the international margin totally collapsed to 6.4%. That's a 140 basis point drop year over year.
Yeah, and we need to pause on that Americas number. Maintaining a 30.1% operating margin in a heavy industrial manufacturing business is exceptional.
It's crazy.
I mean, margins north of 30% are typically reserved for software companies, not companies bending steel and manufacturing physical hardware on a factory floor.
Right.
It just points to an immense amount of pricing power and really localized market dominance in the Americas. But then conversely, that 6.4% international margin reflects the dual penalty they're taking.
The declining organic volume and the acquisition costs.
Exactly. You have the lower volume plus the heavy integration costs of those recent buyouts dragging it down.
Well, management credited the Americas margin expansion specifically to favorable volume leverage and positive PPII.
Yes, the infamous PPII.
Right. Let's translate that for anyone building out a model right now. So PPII stands for price and productivity net of inflation and investment.
Right.
I always think of PPII as a financial seesaw, right? On one side of the seesaw, you have your price hikes and your internal productivity gains. That's the good stuff.
The stuff pushing your profits up.
Exactly. And on the other side of the seesaw, you have inflation and reinvestment costs weighing it down. And Allegion managed to keep the pricing and productivity side way heavier.
Yeah. They generated a $10.8 million PPII tailwind in the Americas.
Which is huge.
They completely overpowered the friction. And what makes that $10.8 million figure so notable is the weight they were carrying on the negative side of the ledger.
Right. It wasn't an easy quarter.
No, not at all. They absorbed a $2 million transactional foreign exchange headwind strictly from the Mexican peso. Plus, those recent acquisitions create a 40 basis point headwind to the margin rate.
Because integrating an acquired company almost always drags down your consolidated margins at first, right?
Oh, always. You have redundant overhead, unoptimized supply chains, tons of integration friction. But the core Americas business was generating so much cash. It just absorbed the peso volatility, absorbed the acquisition dilution, and still expanded the overall segment margin by 20 basis points.
Okay, but let me push back a little here as the skeptical analyst, because I am looking at that 30.1% margin and wondering about the sustainability of it.
Fair question.
Is this margin expansion just the result of a company leveraging a localized monopoly to constantly hike prices on their customers? Because, utilizing price hikes to just offset inflation eventually destroys your end market demand. It just invites cheaper competitors.
Yeah, people will just buy a cheaper lock if you keep raising the price. But the earnings presentation actually addresses that skepticism directly. Management explicitly cited favorable volume leverage as a key driver alongside that PPII tailwind.
Okay, so not just pricing.
Right. They aren't just raising unit prices. They are increasing the absolute number of units moving through their facilities.
So the fixed cost absorption mechanics of volume leverage are kicking in.
Exactly. In a manufacturing plant, your core expenses, keeping the lights on, the heavy machinery calibrated, paying the lease, those are relatively static.
Right. The rent doesn't change if you make one lock or a million locks.
Exactly. Whether you produce 10,000 or 20,000, those fixed costs don't double. So when you achieve volume leverage by increasing output, you spread those fixed overhead costs over a much wider revenue base.
Making every single incremental unit significantly more profitable.
You got it. The Americas segment is demonstrating a highly optimized manufacturing footprint that's scaling up rather than a company purely relying on price gouging to pad the bottom line.
Okay, so the income statement looks pristine in their core market. But EPS is ultimately an accounting metric, right?
Yeah.
It's subject to accruals and management assumptions.
Always.
Cash flow is the ground truth.
Yeah.
And looking at the cash flow statement here reveals a very clear divergence from that massive headline earnings beat.
Yeah, this is the nuance you have to look for. Available cash flow year-to-date was $260.8 million, which is actually a decrease of 5.3%. or a drop of $14.6 million from the prior year.
See, that is exactly the type of discrepancy that flashes a red flag for me. You have a quarter where adjusted EPS jumps almost 18%, yet the actual cash generated drops by 5%.
It definitely forces a hard closure.
It really does. It makes you wonder if they are artificially stuffing the channel with inventory just to hit revenue targets, or if customers are suddenly extending their payment terms and hoarding their cash. What is going on there?
Well, management anticipated the scrutiny on that exact metric. They attributed the decline in year-to-date available cash flow primarily to the timing of sales and receivables.
Timing issues. Classic.
Right. The core issue is that revenue realization was heavily weighted toward the latter part of the second quarter.
So a surge of late quarter shipments basically creates a localized working capital bottleneck.
Exactly. If a massive volume of products ships out to distributors in the final weeks of June, the company recognizes that revenue instantly on the income statement.
Which boosts the quarterly EPS perfectly.
Right. It looks great on paper, but commercial customers operate on 30, 60, or even 90-day payment terms. So The profit is booked, but the actual cash is just trapped in accounts receivable on the balance sheet the moment that June 30th quarter closes.
Okay, so the cash generation hasn't structurally degraded. It just didn't cross the finish line in time for this specific reporting period.
Exactly. It's still coming. But there is a secondary operational issue impacting cash and production that management flagged, and this one is a bit more concerning.
Well,
The company is still working to improve production rates following an ERP disruption that occurred back in the first quarter of 2026.
oh wow, an ERP disruption. Implementing or upgrading an enterprise resource planning system is notoriously dangerous for manufacturing firms.
It's the worst. It is literally the digital nervous system of the company.
Right. It dictates inventory routing, it manages the global supply chain, schedules the factory floor, handles all the invoicing. When an ERP migration falters, it can just completely paralyze the physical movement of goods.
Yeah, we have seen ERP failures completely wipe out quarters for major industrial brands in the past.
Seriously, the fact that Allegion is still actively working to normalize production rates from a Q1 disruption in the middle of Q2, that just shows the incredibly long tail of these IT issues.
Yeah, it lingers.
And it suggests that their volume leverage in revenue could have actually been even higher this quarter if the factories were running completely unencumbered.
Yeah, it acts as an artificial cap on their operational flow right now. While the Q2 numbers indicate they are managing the fallout effectively, any ongoing ERP friction really remains a material risk factor that you have to monitor.
Absolutely.
Because if those production rates don't fully normalize soon, it will eventually degrade their ability to maintain that volume leverage we were just dissecting earlier. The system has to be able to handle the demand they're generating.
Well, evaluating how management deploys their capital usually provides the clearest window into how they view those ongoing risks, right? And how they view the intrinsic value of their own firm.
Always follow the money.
Exactly. So in Q2, Allegion allocated approximately $120 million towards share repurchases. That retires about 0.9 million shares. And they also distributed roughly $47 million in dividends, which equates to towers of 55 cents per ordinary share.
And deploying $120 million into buybacks immediately after posting a massive beat and seeing the stock price react positively is a very aggressive signaling mechanism from leadership.
Yeah, some analysts might argue they were just buying at a premium after a strong quarter. Why buy when the stock is popping? But the raised full-year guidance suggests management believes the market is still completely undervaluing their future cash flows.
Exactly.
I mean, they raised the 2026 outlook for adjusted EPS to a range of $8.85 to $9. That is up from the previous band of $8.70 to $8.90.
And the revenue revisions tell the real story behind that buyback confidence. Reported revenue growth was bumped to a range of 7.5% to 8.5%. But more importantly, the organic growth target was raised to 3.5% to 4.5%.
Which is substantial.
It really is. When internal forecasts show organic demand accelerating despite a sluggish European market and lingering ERP issues, management has the data to justify retiring shares. They are clearly betting heavily on the sustained momentum of the Americas segment.
Now, for those updating their valuation models right now, that adjusted EPS guidance of $8.85 to $9 does exclude some specific line items.
Right, you have to read the footnotes.
Always read the footnotes. They're excluding approximately 0.60 cents per share for acquired intangible asset amortization and about 0.22 cents per share for restructuring costs.
Yeah, and stripping out intangible amortization and restructuring costs is pretty standard practice for analyzing a company's core cash-generating capacity.
Right.
Intangible amortization is just a non-cash accounting convention linked to their recent acquisitions. It doesn't impact cash flow. And restructuring costs, particularly those tied to the international segment's new defensive posture, those are treated as one-time expenses designed to lower the future cost basis.
So management is directing analysts to judge the firm solely on the underlying operational leverage.
Exactly. Look at the core engine, not the accounting noise.
And the underlying operations are clearly generating substantial cash, anchored by that insane 30% margin in the Americas, which is, let's be real, effectively subsidizing the macroeconomic weakness in Europe right now.
100%.
So, we have charted the organic growth divergence, the mechanics of their margin expansion, and the working capital timing impacting cash flow. But I want to pivot before we wrap up. There is a strategic shift buried in the segment reporting that demands attention if you're looking at the long-term trajectory of this company.
I know exactly what you're going to bring up. The transition from mechanical hardware to electronic ecosystems.
Yes, because Allegion and its core brands like Schlage or Von Duprin They're historically viewed as legacy heavy metal hardware manufacturers.
Right, you picture physical brass locks, heavy steel doors, and mechanical exit bars on schools.
Exactly. But the data shows their electronic products in the Americas grew by a low teens percentage this quarter. And on a global scale, electronic products grew by high single digits.
Yeah, their capital deployment is flowing heavily towards smart access control, networked mobile credentials, and integrated security software.
And as they scale this specific product category, the company begins to look less like a cyclical industrial manufacturer and more like a high-margin technology ecosystem.
Oh, absolutely. The switching costs become massive.
Right. When a university campus or a corporate headquarters or a huge hospital network installs an electronic networked access system, the switching costs become completely prohibitive. The customer is no longer just buying a mechanical lock that any locksmith can swap out. They are integrating a proprietary node into their broader IT and security network.
And the recurring revenue potential of software-enabled hardware fundamentally alters the valuation multiple a company can command in the public markets.
That's the kicker.
Right. If institutional investors begin pricing Allegion as a sticky tech ecosystem rather than a traditional hardware vendor, the ceiling for multiple expansion is significant. And that is regardless of short-term macroeconomic fluctuations in Europe.
It's a completely different investment thesis, and the speed of that transition toward electronics is definitely the primary trend to monitor in the back half of the year. So if you want to keep sharpening your analytical edge and understand the actual mechanics behind the headlines, follow the show for our daily earnings coverage.